Hello friends, my name is Dheeraj Vaidya from wallstreetmojo.com. This is part 30 of our ratio analysis video series, and in this installment we learn all about DSCR. DSCR is nothing but debt service coverage ratio. In simple terms, it helps us in understanding whether the company is capable of covering its debt obligations with the income that it generates. In this tutorial, we'll have basically four objectives. Number one, we'll understand what DSCR actually means. Number two, the DSCR formula and calculations. Number three, we'll calculate DSCR for Colgate. And number four, its interpretations. But before we jump into the tutorial, a quick reminder. We'll be needing all the working files of Colgate case study for this video. So if you haven't downloaded it yet, please do so from the link in the description box below. And also, to keep yourself updated with investment banking and core finance concepts, please do subscribe to our channel, Wall Street Mojo. So let's get started. What is DSCR or debt service coverage ratio? DSCR is basically a part of the ratio analysis framework, and it comes into the financial risk category. In our previous videos within the financial risk category, we have looked at the leverage ratio and the interest coverage ratio. Leverage ratio looked at how the capital structure of the company was, like, how much is the debt and how much is the equity, and we calculated the ratio to find out whether the company was over leveraged or under leveraged, and whether those over leveraged or under leveraged position, how that impacted the income statement, right? When it comes to the interest coverage ratio, we primarily compared the operating profit of the company with the interest to see whether operating profit is sufficient enough to cover for its interest expense or not. So that was about the interest coverage ratio. But when we look at the debt service coverage ratio, actually it takes the interest coverage ratio to the next level. Here what we basically try to do is that we look at all the debt related payments. Like, one could be the interest expense, then there would be the principal repayments, and then there could be other set of obligations which the company has already committed to, something like the lease payments. So we add all these three set of obligations: interest expense, and then we add up the prepayments and any other obligation which the company is committed to. Usually it is the lease payments. Okay, so that's called as the debt service. Like, instead of interest here, we take the debt service and we compare it with the operating profit. We want to actually see a position whether the operating profit of the company is sufficient enough to service the debt. That's how the debt service coverage ratio is looked at. So from the point of view of formula, it's very, very similar to what we had in the interest coverage ratio. In the numerator, we have the net operating income. Think of this net operating income as nothing but the earnings before interest, taxes, depreciation and amortization. So EBITDA. Okay, so that's what we are talking about in the numerator. And as I said about the debt service part, the debt service includes the interest expense. Then we have the principal repayment of debt, right? So every year you have to repay the part of the principal so that it extinguishes over a couple of years, right? During its tenure. So that's the interest expense and the principal repayments, and the other committed cost, usually the lease expense. These are the three items usually included in the debt service. So the ratio of the two, EBITDA divided by the debt service, will give us the DSCR or the debt service coverage ratio. Let us take an example to calculate DSCR. Let's assume that the EBITDA of the company is 1000 and interest expense was 100 and principal repayment was, let's say, 300, lease expenses another 100. So the total debt service will be the addition of these three. So that comes out to be 500. DSCR or debt service coverage ratio will be equal to EBITDA or the net operating income divided by your total debt service. So we get the debt service coverage ratio of 2.0 in this case. When you look at the debt service coverage ratio, which is, let's say, if it is greater than 1, this essentially means that the company is in a great position to be in, because it's able to not only pay the interest but the principal and the lease payments as well. It should be able to survive for 1 year at least because of DSCR being greater than 1. Likewise, if DSCR is less than 1, That's where you might see some troubling signs, because either the company will default on its principal repayment or the lease payments, etc. So you have to watch out for those companies as such. A typical good ratio of DSCR, you can take it as around 1.5 to 2. So any company that exhibits a DSCR of around this range should be reasonable and safe. I hope now you understood what DSCR is and how its calculations are done and its interpretations. Let us now look at Colgate's DSCR and see how it works out. So here is the balance sheet of Colgate, and I want you to scroll down to row number 151. This is where we will calculate the debt service coverage ratio, or DSCR. So what's the formula of DSCR, by the way? It's EBITDA divided by your debt service. EBITDA is nothing but the net operating income. And if you remember from our previous video, we already have the EBITDA calculations with us. Look at this, row number 139 and 140. Okay, so we have the EBIT and we have the depreciation and amortization. So when we add these two, what do we get? We get EBITDA. So from the point of view of calculations of DSCR, the numerator is now taken care of. Now let's go to the debt service part of it. So debt service includes three things: interest expense, principal repayments, and leases. Alright, so these three things also we have provided in row number 143 to 145. So what does this long-term debt maturities are? Long-term debt maturities are nothing but your principal repayments. So where do you get these numbers from? So you actually find these numbers from the SEC filing. Usually there's a table where they actually give you what are the pending payments for the next 4 or 5 years. So that's where you will find this kind of a data. Now the second thing to look at is, once you are clear with the principal repayments, you can see this net cash interest. So this is the number that is more relevant for us, because we are interested in how much the cash outgo from interest point of view. This is different from the interest expense that is reported in the income statement. Okay, so if you have this number, please take the cash interest expense. The third part is the lease related payment or the commitments. All right, so this is what we also need to add for the debt service. So let's do that. Debt service will be the addition of these three. Okay, so debt service for 2018 is 307, 341 for 2019, and 587 for 2020. So let's now calculate DSCR. Could be fairly straightforward now, given we have all the numbers. EBIT plus your depreciation and amortization is EBITDA divided by your debt service. Okay, so it comes out to be 13.70 for 2018. Let's copy this for the remaining years as well. So we get this as 11.94 and 7.54. Alright, so from the point of view of debt service coverage ratio, Colgate is very well placed. So I hope now you understand what is DSCR, how it is calculated, and how it is interpreted. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future video, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on investment banking and core finance topics regularly. So if you haven't subscribed to our channel yet, please do so by clicking on the subscribe button below so that you can get the notification about our latest videos. I hope you enjoyed the video. Have a nice day.